Good morning, everybody. Welcome to the Flow Show. It's Wednesday, 30th of August, nearly at the end of the month. Hope you're doing well. I would say good morning to K-Man, but I'm not sure where he is. Maybe he's gone offline or something. Anyway, so let's crack on. Anyway, starting off in China, and the China Securities Journal out overnight with more analysts' thoughts, saying that China's one is to get support from the PBOC and the economy. We pay attention more to these analysts than we perhaps do to some in the Western world, because if they put something out, it can be from the slant of state news drops, if you like, so they can indicate things to come. Yesterday we had headlines that China were going to cut rates on existing mortgages as soon as yesterday. We're still waiting, I think, unless something slipped under the radar we haven't seen before or seen yet. But we haven't heard anything about mortgage rate cuts, although China's Bank of Communications was said to initiate a mortgage rate cut, looking to make the purchase of first homes more affordable and lift the housing slump. That was reported by the SCMP, the South China Morning Post, but we still haven't heard of them actually cutting rates as far as I can tell. In other China-related regulation, China regulators are said to order interbank dealers to stop providing real-time quotes. Now, this isn't new. It's something they used to do in the past. They're going to stop providing public quotes according to new regulations, as their licenses do not allow the provision of public data. Dealers can only provide individual point-to-point quotes. Now, they did something similar to this in March, cutting quotes given out in various markets. They cited security laws when they brought in all those new security measures. So this isn't something new. It's the way they actually used to do it in the old ways. So now people are getting quotes via chat groups. That's how they, as I say, that's how they did it in the old days. So they've gone a bit backwards in terms of that, but it's just another bit of trying to close up the information that comes out of China. In other rate news, apparently fixed term deposit rates at some China state banks will be lowered by 10 to 25 basis points, according to Reuters sources. So we heard about that also, that they might tinker with deposit rates, and apparently there's further smoke to that fire. Now, over at the Bank of Japan, we've had some what could be construed as pretty hawkish comments in relative terms from one of their bods, Tamura, BOJ's Tamura. He sees it as continuing to ease, sees it as appropriate to continue with easing at this point. Hopes to see a clearer picture of inflation in the first quarter of 2024, but says that stable 2% inflation target is clearly within sight, although uncertainties remain for achieving the inflation target. Says corporate price setting behaviour has changed from the period of deflation. There's now a positive cycle between wages and inflation being seen, as wage rises have improved consumer sentiment. On inflation, is likely to slow for the time being, then accelerate moderately again. We can't rule out the chance inflation may overshoot expectations. The economy is likely to continue recovering, driven by domestic demand, and also sees a chance that GDP will overshoot estimates. Says he believes that we can expect high wage growth in next year's spring wage negotiations, but we need to base decisions on the data as the figures come in, and a little more time is needed to judge on the price target. Speaking about exiting, he said in the scenario of exiting easy policy, ending negative rates and YCC are all options. However, abandoning the negative rate wouldn't be monetary tightening or a rate hike, as monetary conditions will remain loose. So RCK's popped in. Maybe we've found the hawk among the doves.
Hey, good morning, everybody. Yeah, I mean, you can qualify it as he's one of the Bank of Japan hawks. He was already speaking about that inflation last year, actually. But yeah, the Bank of Japan hawks would still be qualified as doves elsewhere. Yeah, but the thing is as well, I mean, he's talking about January and March. You can hardly say that is going to get the market all excited and going all gang ho on here we go. You know, it's hard to get really excited, even though he's one of the hawks. It's Ueda has already told us on where was it, on Saturday, that he's not in a hurry. Yeah, well, yeah, he's one of the hawks, and that's it. But then he's not saying that they should start to change stuff over the next meeting in September. And that again, I think the market is just going to shrug its shoulders and move on until they really change something.
Yeah, but it's interesting to hear some of his thoughts on the exiting. You know, they're at negative rates, and he's calling it going from negative to zero. Okay, it's only 10 pips, but it's still a rate hike, and you can tell they're not going to sell it as a rate hike. They're going to sell it as just undoing negative rate. So you're getting an indication of how they're going to exit when they do. It's not going to be turning around and hiking in 50 pip clips. Exactly. Like we saw everyone else do. It's going to be slow and steady. But although he's always put that Q1 2024 target on it, it's not going to stop the market maybe getting a little bit hawkish again when we get close to meetings, looking for further language changes from some of the others, a bit of a sentiment change. So, yeah, we're not expecting any huge moves, but we've seen prior meetings, the market gets a little bit hawkish into it, starts covering positions and whatnot. So I think when we get comments like this, we need to watch out for similar at each BOJ meeting, even if they do nothing. But the snowball continues to roll. One day, maybe we'll see them out of monetary policy. Maybe before we're old and grey, Kay, or older and greyer.
Yeah, older and greyer. Yeah. I hope I can see a change before I retire.
You're going to retire at some point, are you?
Well, I don't know. It depends. If I win the Euro Millions, I'm retiring tomorrow, mate. No, actually, not tomorrow. Friday, Saturday morning.
Right. Okay. Well, I'm not. I'm retiring in the grave, trading to the grave, as far as I'm concerned, because it's too exciting not to trade. But anyway, who knows? If we share the Euro Millions, then I'll join you on the beach, mate. In the meantime, we crack on with trying to earn some bucks out of this game. PM Kishida over in Japan has all but confirmed that they're going to bring down the retail gasoline price, or has confirmed they're going to aim to bring down the retail gasoline price to extend the subsidies that were due to end September. They're going to be kicking on. Over in upside down land in Australia, we've had some CPI data out. If I can find it, there we go. CPI a little softer than expected, 4.9% year on year. This is one of their new monthly numbers that they started doing this year. Usually they print CPI on a quarterly basis. So this is a new year on year number. So some analysts saying that all possibly rules out another hike from the RBA, as one source, Newswire, quoted, it's hanging by a thread on whether it's hiking or whether they're going to hike or not. Numbers keep continuing like that. They probably won't, but we shall see. Inflation day in the rest of the Eurozone and elsewhere. We're getting the regional German numbers popping in, bit mixed. No real huge changes. North Rhine was the early number, up a pip to 5.9. We've had some of the others. I don't know if they list them all here. Let's have a look if I can find them. They were all, there we go. So Baden-Württemberg up 2 pips. Bavaria down 2 pips, Brandenburg up a pip, Hesse down a pip. So you're getting a message here. Some up, some down. What it all is doing is staying sticky around that high sixes mark. We get the pan-German number later on today. We can find it, and it's going to be expected in. CPI down 2 pips to 6%. The Eurozone measure down 2 pips to 6.3%. Given those numbers this morning, anywhere 6.2 is probably reasonable to be expected. So we probably won't get much change if it's up a couple, down a couple on that expectation there. Now, what is coming in the pipe for Germany is wages, and they've risen at a record pace in Q2, up 6.6% versus 5.6% in the prior quarter, the highest since the data began in 2008. It's also taken CPI, it's also taken wages above CPI, so wages have finally turned positive over there, though they have been stagnating quite a bit. What that has done, or what it will do, is it will get some Bundesbank hawks worried about a wage price spiral kicking in if those are maintained. And Germany went through the similar situation to the UK in terms of lots of strikes, lots of wage demands, the big industry wage negotiations they have at the end of the year, beginning of the new year, all kicking in as well. So that'll be something that they're worried about. It'll also be something that the ECB will be worried about. They don't see wages as a definitive problem right now, but if we're seeing wages continue to rise across the Eurozone, it is going to start reflecting more in their language and their thinking down the line, and keep them on the hawkish side. So that's something we need to keep an eye on. Spain CPI was out this morning as well. Where has it gone? There we go. CPI up 2.6% versus 2.3 prior. Was expected that high as well. The Eurozone measure, not as high as expected, but still a jump up to 2.4 from 2.1. So just starting to see a bit of stickiness coming in to the inflation numbers again. We saw US inflation moving higher. We'll keep an eye on the rest of the mob over there to see if it follows suit in some of the other numbers, which we'll get, I believe, later this week. UK mortgage data was out as well, and that all-important consumer credit number. Mortgages, they were a bit softer, 49.4K versus 51 expected, down 10K, give or take, from last month. But looking at these numbers, the total mortgage lending was pretty flat. Usually you're looking for something in the billions. So, 230 million versus 111 million prior. That suggests to me that although we're getting decent numbers in the mortgage approvals, the mortgage lending is looking like it's remortgaging rather than new lending, which tends to show up in these numbers more. So this is people probably locking in rate hikes or locking in rates as best they can for fear of further rate hikes. Plus, we've also got a lot of people coming to the end of their mortgage deals and seeing refinancing there. So not a huge ton of new lending going in there. In the consumer credit numbers, always look at that plastic spending to see if there's any red flags popping up. That was unchanged, 600 million, so still pretty much half of the total consumer credit borrowing done there. The rest, credit, car loans, other lending like that, was down to 600 million from 1 billion. So again, no real flags coming in there in terms of people getting out their depth on borrowing. Just poking back to yesterday, got some house price data coming out as well. The F.A.C.E number coming in a little bit hotter year on year, up 3.1 versus 2.9, hotter on the month as well by a pip, although lower than last month. The S&P Case-Shiller numbers as well, looking fair enough. House prices down 1.2% in the 20 city metric, but not down as much as expected. up 0.9 on the month. So nothing, again, no red flags coming from house prices here. It has been a bit of softening, which is to be expected, but nothing that anyone needs to worry about just yet. So the housing market tickety boo for the moment. What did take a little bit of a stinker or a sinker, however you want to call it, was the Conference Board Consumer Confidence. It was expected to rise 2 pips. It fell pretty nearly enough 10 pips to 106.1. That took the market a little by surprise. However, what was big in the numbers was that 1 year CPI expectations rose a pip. So that was a bit of a counter to those numbers. All the underlying components dropped. Current conditions fell to 144.8 from 153 prior, and expectations fell to 80.2 from 88 prior. So soft numbers all around the consumer. It has been on a bit of a strong run of late, so no surprise to see a bit of a pullback perhaps. But as I say, those 1 year inflation expectations, that keeps the Fed on the hawkish side as opposed to seeing the consumer weakening overall. Jolts was out as well, as you can see there, a drop to 8.827 million, further pulling away from that 10 million mark that was very sticky all through the year. That added to the Fed's, well, some have taken it as adding to the Fed's soft landing, I see jobs growth pulling back a bit, but the details again underneath weren't that bad. The quits rate, this is people who decide to change up jobs, was largely unchanged. Separations, layoffs, discharges, i.e. people coming out of the workforce being laid off or whatever, was down. So that's not a negative at all. That's a positive. That means people aren't getting laid off. So although the job openings flags one thing, so what this does, it shows firms offering positions. There's lots of questions over this data, whether it's good data or not, but what you can ascertain for that is either firms aren't finding that they've got the positions available now, or they don't want to offer the positions anymore. That could be due to increased costs, so they can't afford to take on new workers, therefore they won't advertise new workers. So that's something that if it continues, it may mean that we then start to see job losses coming in, because if people aren't offering jobs, then you're going to get more people who can't find a job, and thus unemployment stays high or starts creeping higher, because if firms are finding it tough or they haven't got enough money to employ people, the next step is usually that they start getting rid of people. So that's why this number is looked at quite significantly. But as I say, the underlying details suggest that there's no issues just yet. But this is one we need to keep an eye on. Yes, mate.
It is very good for the Fed. I mean, that is exactly what the Fed wants to see. The demand in starting to slow. The big number in there is the ratio that we see between the offerings and people looking for jobs coming down. So that is that ratio is really playing into the Fed's book right now, because that's what the Fed really want. They wanted to re-equilibrate the discrepancy or the divergence between the demand and the supply. And now people demanding workers are starting to come down. So that's really good for the Fed. And I think that's where the market reacted so abruptly or violently, especially in the equity markets, thinking that it's really now doing the Fed's job, and that is really what they want to see to firmly remain at least on pause right now. Where the balance could become really bad is that if we get a bad labor report at the end of the week, because then that would mean that both demand and supplies and that the whole labor market is starting to falter, and that's what we've talked about as a very big domino. I think we'll have to see the combination of those numbers and what's going to happen. Well, ADP is one, but especially at the end of the week on Friday, what's going to happen there, and that could then provide us with a more clear picture, right, for this month.
Yeah. So what I mean, this JOLTS data is a bit lagging, as you can see. It's July data, so it is a bit behind the curve. But really, what you want to be trading or looking to trade is whether we see a softening in the jobs market. That's a nice shallow slope down, shall we say. If it's a cliff edge, then that's going to cause all sorts of problems. So if it's a nice smooth slowing of jobs, unemployment rate just ticking up a tiny bit, maybe we're getting 100k job gains and just a little tick up in unemployment, that's all fine and dandy. If it goes off a cliff, or otherwise, if we start seeing negative 200s employment rate going up 3 pips at a time, that sort of thing, then that's a different kettle of fish to trade, and the market's going to turn to cuts really quickly and quite violently. So that's how you need to judge it when you're trading this data. And this JOLT stuff, as I say, doesn't signal anything cliff edgy at the moment. Shallow slope, shall we call it that, is what it's looking like at the moment. But we'll keep an eye on it. We'll wait for the next one. Just in other news, apparently Walmart is asking pharmacists in its branches to voluntarily take wage cuts and reduce hours worked to save costs. Cuts are aimed at higher paid pharmacists nationwide. So there we go. That's another indication that we may start to be seeing turns in the market. If someone like Walmart is asking pharmacists to take wage cuts, they're not going to be looking to perhaps take any new pharmacists on. So that falls into the JOLTS data. So things like that. Now you can see how all these numbers are put together and how it works in the real world. So big employer Walmart looking to cut costs there. If that starts to spread to other departments, other places, that's going to flag up some problems to come. That's it. All I've got on the news front. Anything you've picked up, Kay, you want to share?
Not really. No, nothing. Nothing really market moving. No.
Cool. No worries.
Covered it all.
Sorry, mate.
You covered it all. Let's look forward.
Cool. Yeah, no worries, mate. Ali, I'm assuming you got your big figures wrong in your euro sterling trade. I hope you're not short at 85.05 while it's trading 86.05. Otherwise, you would have been stopped, mate. So I'm going to assume your question is a big figure higher. Yeah, so you're short up at 86s. Let's get it on the screen. So, yeah, the old scene of the crime, around 86, 86.10. We've been here before several times. That's why it's a level on my chart. It's a bit up and down. Sometimes we hit it, sometimes we break it, sometimes it's support, sometimes it's resistance. So you got a trade on there. The only thing I don't like about this, as you can see, is we banged ahead, we've dipped, but we've come back pretty quickly. The price action suggests that we might be up for a little break, but this is euro sterling. That can take 5 minutes or it can take 5 days. But for me, I'm still long down from the bottom here. I'm happy to see it up here, and if we do get a break, maybe we'll be looking at for another nudge up to mid to high 86s. But for now, you're short up there. Take profit 84.75. Yeah, that's a fair enough distance away, but watch that we've had this dip and it's got balled up pretty quickly. Suggests the price action is a bit bullish this morning. You're looking for more rockets and big moves, I see as well. What can push the euro skyrocket higher? Ooh, skyrocket. Yeah, it's had a little bit of impetus, obviously, from that data yesterday from the Fed. And this is the market in a nutshell. This is how we can swing day to day, data point to data point. 1 minute we're under 108, perhaps looking a bit softer. Bounces are a bit shallow. Can come back just as quickly. And now it's looking like we might be heading up to 110. So it really is light switch markets at the moment. So you've got to pick your levels. As you can see there, we hit the trend line. Not that one. That one. So we hit the trend line again. You know, I'm not going to say the trend line did its job. The numbers came out and helped it do its job. The data helped do its job. So if we hadn't had that good data, or that data as it came out, bad data, depending on how you want to look at it, we could have been through there and heading towards 107. So this is one of those times where it looks like the text did its job, but I'm not so sure. I think there was a bit of luck from the news and data, but it is what it is. We're back up testing towards 109. We got some moving averages up here. The next number 109.40s, if we get above there, is a bit of an old pivot support and resistance point, so you got to keep an eye on that. Do I think it's going to 112? Who knows? It's, as I say, this is light switching between data points. We get really decent ADP later. We're expecting 195 from 324 last month. If it comes in 350, we're probably going to go down to 108 again, maybe even under. So right now I'm very neutral on direction. I see nothing that really kicks us one way or another significantly. So I'm just going to sit either side. If I see a level I like, I'm going to trade it. If I don't like it, I'm not going to trade it. But for me, yeah, it's just a bit all over the place at the moment, and you've got to be ready for that to swing between the data points. What are you making generally, K prices? Obviously, we've got end of month in the mix as well.
Exactly. We are in end of month. Yeah, we had those data out, but then on Friday everything can change again with the NFPs. I don't know. I really want to see us pass this week. Now, the question was like how euro. Yeah, but the thing is, I think you asked your question about with the undertone of saying it can't go higher, because you say like, what about recession fears? How euro long justified if US data continue to beat? Well, the US data are not beating. Now, looking forward into September, there's a lot of people coming back online. Traditionally, the seasonals say that it should be a good month for the dollar, but if this Friday we are seeing a notable slowing in the US jobs market, we know what the reaction is going to be, right? I mean, the dollar is going to get hit because it's just the biggest market. But it all depends. And I'm saying like a bad report, okay? That's something below 50K or and several tenths of % higher in the unemployment rate, then the dollar is obviously going to get hit. Now, what is really going to put the euro higher is better data out of Europe. And for the time being, yeah, we are just playing ping pong in between levels. Yesterday, the dollar fared less well versus everything because of those data. It threw also, we cannot forget and not omit that, it threw the end of month models not upside down, but it threw them virtually in the water, into the water, because before that there was a lot of models, and most of them predicting dollar buying for the end of the month. We did see it yesterday unfold until those numbers. And but now, with those equity markets having rallied, with the bond markets having rallied, there is likely a lot less to do. Perhaps even if people have already done it, there may be nothing left to do. So it's an open play until tomorrow evening, tomorrow afternoon in that regard. Yeah, what I think is just data, that could turn it around. We have sticky inflation in Europe, but then on the other side we have weakening other economic data weakening. And we haven't seen the last big dominoes in the States really fall over, and one of them is going to be the labor market. So get bad data in the US, then you're going to see the dollar roll over more than likely, you know. And until then, it's sit back and wait, see what's going to happen in trade ranges.
Yeah, exactly. I mean, I took a little bit of a pasting yesterday. After that data, I thought I'd buy the dip into the broken sort of 146.50. I did at 145. I got stopped out at 144.80. Sorry, 145.80. I was in at 146 and 146.50s. So yeah, I thought we might get a retrace of this data on the end of month stuff, and it didn't happen, or didn't happen as quickly. So, you know, sometimes you can do a little fishing and you end up catching an old boot or nothing at all. And that was the story of my dodgy end. But, you know, then again, that suggests that all that move was end of month more than anything else. You know, the flow's coming in. Then as soon as we get couple of big pieces of data, bosh, there's suddenly no bid in the market and you're off nearly 200 pips. That's the way it works out. And we've seen a little bit of a clawback today, but it doesn't look as strong as what we saw yesterday. You know, maybe we look to when the Yanks come in, see if there's more to be done. But again, you know, it's hard to try and find a trade in all this. And if you're going to try and trade the breaks like I did, you've got to keep it small, keep your risk manageable. So if you do get caned, if it doesn't work, you're not going to break the bank doing it. You're not going to lose your account doing it. You lose a few pips, you lose some money, you get up and you're going to again look for the next trade. So dollar yen in general, you know, look at it from a technical perspective. We had a bit of a rally up. Let's see what that 38.2 fib is. So it's a bit of an old one. Historically, I can't be bothered to go all the way back because it must be a big one. But that's an old level up there, 147, just above 147 there. So decent level. It's near enough some of the old traffic area when we was up at the highs, but it's reversed pretty quickly. So all the work has to be done again. We're already trying to resist at 146.50 again, as you can see around there. So the old level, the old traffic zone that we had prior to that break is back in play again. What it does from here, I have no idea. Some of the other pairs already looked at euro sterling. Kiwi still keep an eye on. That's now made a bit of a bounce. Didn't quite get up to that 59.90. The prior high is up there again, up towards that big level up in the towards 0.60. So still not out the woods as far as what's going on down here at the lows at the 59s. You know, not even making a new high subsequent to that one back last week. So again, significant price action shown here that's not quite ready to push up yet. So it's still in the balance. Just holding this intermediate level around 59.40s. If we get below there, then we're probably heading back down, and I'll be just as cautious if on another move down to 59 as I was yesterday before we got this bounce. I don't think we're quite done here. I did chop a bit more of my longs. I'm going to keep my sell stops the same size down below this trend line, which I am nudging down a bit as the trend line moves lower, because that is where I want to park my stops below, but I won't let it get too far. I might adjust that trade if that trend line continues moving significantly lower. Kay, do you want to have a look at a few?
Yeah, why not, mate? I need to show something because there's been something strange going on in the short-term sterling yields. This happened yesterday at some stage, and so there's been this big jump, like 20-25 BPs in the 2s and in the 5s, and in nowhere else. And we were trying to figure out what it may be, and why cable didn't really follow this move. It does seem to be correct, because it gets updated again. Now I don't know whether there's been some contracts being renewed, whether it's end of month rebalancing, but we need to keep an eye on what's happening over there, because it's only the short term. It's not the the more medium term. Yeah, it rallied a bit, but we're talking about small BPs here. But if you look at the differentials as well, it went like really sharply in favor of the sterling. So we've got to keep an eye on sterling on the back of this into month end, because it could be only month end, and we haven't seen the sterling benefit from it. Other than being a bit higher versus the dollar, like all other currencies are. But as I said, perhaps it's like some contracts are rolled over, or month-end stuff, and we are scratching our head a little bit. If anyone has a plausible explanation, that may be maybe come in handy.
Would it be the bond roll if those yields are indicative of futures prices?
Yeah, it could be the bond
over,
rolls. It could be, you know.
Because obviously September's a contract.
Yeah, it's a very active one, right? It could be, but it's a big move, and correlation algos must have been switched off because nothing picked up on it. We even fixed a pretty low one in the cable yesterday, right? Around 4 p.m. All right, dollar yen. We ran up to this extension here at 147 and a quarter, even went a little bit higher. I think it's a combination of both. One thing is end of month, as Ryan already said. The other one is they're not giving us anything to chew on when he was in the hole, and I reckon that was the combination. Now, if we wouldn't have had those numbers, I think we would still be trading up here. I'd say if you look at what the equity markets did over the month, I don't really know the bond market, but it could be that the yen remains on the defensive until tomorrow evening, actually, or until tomorrow 4 p.m. London time. It could be. I'm not saying it will. I say it could be. Okay. It looks as if the yen crosses remain underpinned, and testimony of these is this euro yen. We are very close to those highs we had a bit earlier this month, and if you look at it, and I have to go back onto the weekly, because the last time we were above 116 in the euro yen was back in 2008, and so we are very close, and I wouldn't rule it out that we are going to have a look at this extension here, 163 quarters perhaps, before the month is over, right? And I don't know, it looks like euro is pretty big, and the dollar yen is just higher, I think, due to those crosses. We find it back as well in sterling yen. Okay, no, that's the cable. Sterling yen. All right, it's not as high as the euro yen, obviously, because euro sterling is a big figure higher than a big figure of the lows. But we are gradually pushing again. So yesterday we had this the data caught the short yen off guard, but then we are already back at those levels. If you look at the crosses, we are back and above even those levels that we were trading yesterday before the US data. Okay, and there's many of them. There's many of them, and that's what makes me think that, okay, the market is probably trading that Bank of Japan being slow as well, but that makes me think, if you look at Aussie yen has broken up, for instance, yesterday and Monday afternoon and yesterday, makes me think that we may need perhaps a small extension to this before the month is over. So just to keep an eye on what's happening in the yen. Yeah, Brian, I know you always like the cable. Sorry, we are back above this 15, call it 15.25 zone in the cable, holding pretty well. I think the next level here is back at 126.80 before we can start to talk about 127 and a quarter. Let's quickly look where the fibs are of this latest move. Yeah, it's all around there, you know, 80, 90, and then low to mid 127s. Those levels are still roughly valid. If we would start to get higher again, if for instance we would have like another disappointing US data point. It's going to follow the rest, I think, because I don't see much many moves on the crosses, barring sterling yen. But it could follow the rest of the dollars, and why not? Now that we are back above this 126.1530, that we push up a little bit higher. It's not. Yesterday, those numbers and the subsequent equity market and bond reaction, as I said earlier, they may have killed a lot of those models calling for the end of month. So for me, they could have been completely trashed, those expectations, and I'm going to be data dependent really on for the rest of the week basically, and I don't have a very big view, but something tells me in those end of month models though tells me that the euro is not, it may not get sold off versus the dollar as much as the rest. So that tells me that perhaps the euro crosses are just going to keep their bid tone. We are in this wedge again, try to break out, went back into it. Here we are, 109, and then I think Ryan already mentioned that those 109.40s, they are going to be a level to watch. And again, I don't have a preferred direction right here and now. I'm really going to be data dependent. It could be that on the next set of data, we are back at 107.75. I think we should find buyers on dips also because of the equity markets, but I'm not picking a direction right here, or I'm not entering into anything right here anyway. There's an interesting one to watch on the crosses. Yeah, dollar Canada is back into this zone here. It's a bit of a strange one because oils have rebounded very sharply on the back of the API yesterday. APIs came out with a really big draw of over 11 million barrels. It's really a blind dart in that stuff. But look at this one, and this one could get interesting as well. If we are turning around this level, we are turning around. This is around 147.60. We tried once. If we fail here, there could be a bit of a move lower down. But if in turn oil fails, with the way euro behaves right now, then we could be in for a little bit of a break, just in terms of today and tomorrow, you see. We could be. Just keep an eye on what's happening around 147.60, okay? And then if we fail, then we are talking again about those mid to high 146s here, which is now like really starting to be a heavy traffic zone. Every time we get there, there's a bit of activity, somewhere between 147 and 146.75, okay? But I find it an interesting watch, this one now, because we are perhaps trying to go or in turn fail here, okay? So that's an interesting one for me to watch. Silver held the resistance. Silver held the latest resistance, the one that we've started to build up from May. So that one needs to be respected around 24.80. We spoke about that level already before. Yeah, I mean, just respect this trend line, I would say, and then see where we end up and where we start the new month. I think if we start to push through in September, then I think there's really potential for going higher. If in turn we are respecting this trend line, then we could be doing something like this, for instance, which would then have the potential to get this which I think last leg lowering, but that's music for September, right? This last leg lowering, that is a fresh possibility that we are building on, unless we start to break. Okay. Gold as well. I told you that we had to monitor those 1930s. We haven't broken here. We're still a bit away. Call it 45.50, 45.52. That's an important zone, in my opinion. For as long as we're below, we can have something similar, like in silver, for instance, and perhaps start retest this 1900 at some stage. The jury is out there, and but it's worth, and especially going into September, then it's going to be really worth watching a few instruments, what they are starting to really tell us. Okay. Anything else? Aussie capped 64.90. That's it. 1, 2 attempts, and we're back down. I'm not saying that we are going to go back down here, but because in turn that was a bit funny, because we had a lower CPI overnight, and we also had weak building approvals or weak construction numbers, and yet we managed to get back into the 70s this morning. I was a tad long, and then I went like, yeah, all right. I mean, on those numbers, it should not really be there. So I took them off. I'm just waiting. But it's funny that we did not stay low on weaker inflation data. And that is something that we need to keep in mind. If the market does not react to CPI as much anymore, because we are on a trend and a known trend, then you have to look at for something else, right? Now, what else? Yeah, the Kiwi already done. CNH, still nothing burger around 7.30. I guess as well that we have to wait for September now to see what the investors want to do with this. Okay, I'm very, very tiny in it, and really I'm waiting for fresh developments. And really, for now, that's it, mate. I don't have much else to talk about.
Yeah, I'll take it back quickly.
Yeah, it's always tough when we have like this mix of a lot of data coming out, and then the end of month, although August should not be your biggest month in volumes, but and when they start to contradict each other a little bit, it's for the short-term trader at least. If you have longer-term views, that's a different thing. But for the short-term trader, it's not an obvious daily update, I would say, right now.
Yeah. Can you see my screen okay?
Yeah, mate.
Yeah, cool. So just to Larry, I'm assuming, I don't know, you might have a different DMA, but my 4-hour 200 DMA, my 4-hour DMA is just below the price at the moment, not resistance, so 1934. But you've also got the daily there as well, the 55 DMA around that level as well, around that 33, 34 area, 32s even. So it's a bit of, can it define up and down trend bias? I wouldn't say it defines the trend bias. It's just another support or resistance point. So it's important how you trade it. You know, there's a bit of a zone in this 30-40s. So there's a lot going on in this zone. If we're above 40, then it's looking more constructive for the upside. If we're below 30, it's 35, it's looking less so and looking more bearish. So sometimes, you know, you add all the text together, it's not going to be one number, and you define it by whether it's above or below a particular area. And that's all you can trade. But just on your point on bias, and Kay will answer this as well, it's not that we have a bias for a currency on its own. We have a bias based on fundamentals, on news, on data, on what's going on sentiment. That's what drives certainly my bias for a pair or any asset. It's not, I think this is going to be bullish, therefore I'm going to buy it. It's just part of how we trade every day. You build in the picture what the data's doing, what this is doing. It's like saying about, you know, we're going to be trading the rate cut trade end of this year, beginning of next year. you know, I'm saying this now in September, and none of you are going to remember what I've said in September when we're in February. But if we're in the middle of the rate cut trade in February, you know, that's what I'm looking for. I'm looking for it now. That's what I feel. That's what the data's indicating, that if we're going to get a softness that we're already seeing, it's likely to grow. And it's going to be around that point that the market really turns to trading rate cuts. That's what it feels like at the moment. It could all change with the data up until that point, but that bias is only built on sentiment, price action, data, fundamentals, central bank speakers. That's what goes into the mix and deciding whether something's bullish or bearish and how we want to trade it. Anyway, that's that. Keep an eye out for the ADP later. As we know, it can be a bit hit and miss regarding what it indicates for the NFP, but we're in heavy data dependency mode. So that 195K expected is going to be a bit of a marker if there's a big variation, and everyone will jump on it. Keep an eye also on our social media, ForexAnalytix, because I will have the NFP compo up shortly after the show. Have a great day, everyone. Thanks, Kay, for all your valued input as usual, and we shall see you all tomorrow.
Thank you, everybody.